All right, what is going on, guys? Welcome to Stock Talk with Nico Criticos. It's been a while since we've done a video here, but today we're going to be looking at 8 stocks to buy in the month of April. The first one on my list is going to be Adobe. This stock I've been buying for a while, but it keeps crashing, and I think the PE ratio is pretty cheap on this stock, so I'm happy to be a buyer of Adobe. I think this company is going to benefit a lot from artificial intelligence, and we should see their profit margins go up. So I'm happy with Adobe. Their earnings are expected to go up a lot over the next couple of quarters. And yeah, I'm happy buying this one. Maybe it drops a little bit lower, but I'm still happy buying at this price. Then we have Tesla. This is almost the cheapest we've seen Tesla in years, because the last couple of years, the cheapest forward PE ratio it's traded at has been a 34, I believe. And right now it's right around there at like a 36 or so. So Tesla, $150 a share, super cheap. It hit this price back in what, maybe early 2023. It hit $150 a share. But other than that, it's been trading above that price for almost a year and a half now. So PE ratio is cheap on Tesla. I think in the short term, we have inflation problems, we have interest rate problems affecting Tesla's market and sales, but I think by 2025, I think that will pass and things will be a lot different. I think once interest rates go down, I'm not saying that's going to happen anytime soon, but maybe at the very end of this year, or if not even 2025, when rates go down, then I think that will help Tesla's sales and profitability a lot. I think I'm not only betting on Tesla's sales with EVs, but also with the energy storage business and all the other things they're working on, like the robots, like the insurance. They have a lot going on, so I'm happy to be a shareholder of Tesla. Next up, we have SoFi. This one I'm definitely not making into a big position yet because it is such a, I don't want to say risky company. I guess you could call it a risky investment just because they just hit their first quarter of profitability, I believe, last quarter. So that's why I'm keeping this a small position. But at the same time, that's okay because this stock also is one of the only ones that has a more likely potential of the stock, 2xing or 3xing, because it's been $7 and below for almost 2 years now. And they've made a lot of progress. How I said, first quarter of profitability was last quarter. But not only that, their revenue has gone from, I believe, around $1 billion to now they're going to do about $2.3 billion this year. So they're growing revenue at a strong clip. The profitability is finally reached this company. And then we have their members at 7.5 million users. I see a lot of bullish signs for this stock, so that's why I'm happy to be a shareholder. Then we're going to look at next one, UPS. This one, it feels like I've owned this stock for a while, but it's just because this stock has a really big moat. And it's the same thing with this as it is for Tesla, where in the short term this year, since we have inflation problems and the economy is kind of just not doing great, UPS numbers are going to struggle a little bit. And they said that they lowered their guidance for this year. And that's why the stock's down 25% on the year. So did I buy into the stock too early? Probably, yeah. But it's still UPS. It's still one of those companies that is super important to the global economy. And not only that, but it's not like we're going to see a bunch of competition in this space. You do have things like Amazon, which may affect them. But I think even like the USPS, like the post office and stuff, I think their prices are even way higher than companies like UPS or FedEx. So I think UPS and FedEx are in a really good spot. And yeah, I mean, where the stock price is right now, I can't imagine it going any lower. I feel like it's really been pushed down. And I would like to lower my cost basis on this. It's just that this stock is already such a big position of mine. I bought a lot of shares when it was, $170, $180 a share. I probably shouldn't have done that. But I just felt like they were one of those companies that has a super strong moat, super strong competitive advantage, and just a company that's not going to be easily disrupted. And I still believe that. I don't think, other than a company like Amazon, which has been around for a while now, but other than a company like that, I don't see, something else really interfering with their business model. So that's going to be UPS. Then we have Nike up next. Nike is one where it hasn't really been moving a lot lately. I mean, it's another one where it has a super strong brand, super strong competitive advantage. But look at the stock chart is only up the stock's up 7% in the last 5 years. In the last year, it's down 25%. Another thing with Nike is their, how I said with inflation, that's also hurting a company like Nike because their sales are going to be down. And then, it's been going on for a while now, but at least for over a year or two, with the whole thing where the way they switch their direct to consumer business around, that's also going to affect their sales. I think in the long term, or at least in the next couple of years, we should see that help their profitability a lot. Well, it already has helped their profitability because they're not relying on other retailers like Foot Locker and stuff. So it's helped with the profitability. It just has hurt their revenue and their sales because now their only way to make sales is going directly through Nike. So that's where that could take a while before we see their revenue go back up. And maybe we might even see in a year or two them going back to their old model and saying, okay, we're going to work with companies like Foot Locker because we want higher sales and we're willing to sacrifice lower profitability for that. So I think that's also a possibility in the future. So Nike, I'm down, I got 23 shares, I'm down 8%. This is one where it's like, I'm not in a huge hurry to buy shares of this. I'm only down 8%. I can easily see this bouncing back up. And I don't like stocks that don't do anything. So if I hold I've been holding this stock for a while now. And if it just sticks around $100 a share, then I'm probably going to sell out. But I think it's also a reasonable expectation to see the stock go to $120, $130 a share. That would be best case. Well, best case scenario would be it returns back to these prices of like 150. But even at 130, I would be happy. That's a 30% return. So I would be happy with that. But at this price, I think the risk is very low with this. I feel like worst case scenario, buying Nike right now, you're pretty much going to break even. That seems like the worst case scenario. I mean, do they have a ton of growth going for them right now? No. So I'm not expecting some huge 2x on my money or something. But I just would like to see a little bit of a bullish run for this stock so I could sell out of it and get my returns. But it's Nike. It's one of the most well-known brands in the world. So I'm pretty happy being a shareholder with that one. Now, Starbucks is the next one. The only problem I have with this that I wish I would have thought about more when I started buying is their balance sheet. Their balance sheet has a ton of negative equity, a bunch of debt. That's the only bad thing. That's what I really don't like to see. The good part is that, again, Starbucks is one of the most famous brands on the planet, and their sales should be through the roof and growing. One thing that also could be a negative for this company's growth is the fact that they have so many locations, and it's kind of like, where do they go from here once they have, I don't know, I think they have 20,000 locations or something crazy like that. The good part, though, the best part about this company is that they charge a lot of money for coffee. They have a very addictive product. They're pretty much number one in their space of selling coffee. And there's always lines at all the locations, right? Anywhere I go, I've been to probably 100 plus Starbucks locations. There's always a line. There's always people willing to wait and pay $5, $7 per coffee. So that's the good part. So I'm down 10%, not great. This one is very similar to Nike, where, as you can see, this whole year, it's pretty much been around 95 bucks. It hasn't really moved much. So that's the bad part. Am I in a huge rush to buy more shares into this? No, not really, because I'm only down 10%. And I already have quite a bit of money. As you can see, it's 8% of my portfolio. So I already have a pretty decent position in this. Otherwise, I would like to lower my cost basis because I think Starbucks at 85 bucks is pretty easy money. The P ratio is relatively cheap, not super cheap. It could go lower, but it definitely will go higher in the future. It might take a year, might take 6 months, who knows? But this, I might even buy a couple more shares of this just because at this price it looks so cheap. Like I definitely see it returning back to $95 in the short term, and then again I'm hoping for it to shoot up to 110, 120 for me to get that 20% return, and then I can sell out. But yeah, the good thing about Starbucks is that they are very dominant in their space and they have lines out the door for every location. The bad part is that there's not much growth ahead for the company. Starbucks is kind of at the point where they're like a Coca-Cola almost, where it's just like you're gonna get a couple percent return per year, and let's see, what's the dividend's 2.5%, so not that great. I mean, 2.5% would be good if if interest rates are at 0 or 1%, then that's fine. They could pay a 2 or 3% dividend. But right now, you're better off just keeping your money in cash and earning 5%. But yeah, that's the only bad thing I don't like. The bad thing I don't like about Starbucks is that negative equity on the balance sheet. That's something I really don't like to see. That's going to cost them lots of money. But it is what it is. Next up, we have Lululemon. This is a new one for me. And the next stock is going to be a new one too. These are two of the only new ones, I believe. The rest of them I've been buying for at least a couple months. So Lululemon, this is another one where it's similar to Nike. It's an apparel business, and with that, especially a high-end apparel business, we're going to see their sales being hurt because of the whole inflation thing and consumer spending this year. So that, and I think the reason the stock dropped big a month ago was because of that reason. Was they lowered their guidance, and I'm sure that's the main driving factor for why the stock keeps going down. And to be honest, I probably bought in too soon. I mean, I know better to not buy a big position as soon as like the day the stock drops, and that's pretty much what I did. I believe, let's see, the day the stock dropped and it went to, yeah, it went to $400 a share. That's when I bought all my shares. And then since then, we're sitting at $338 now. Probably would have been a good idea to wait a little bit, but I just thought this was a interesting opportunity. I'm kind of curious. Let's look at what the forward PE for this stock is compared to where it normally is, because Lululemon, when you look at the analysis and stuff, they have plenty of growth ahead of them. So I'm not really worried about that. Like maybe it doesn't happen within the next couple months, but definitely by 2025, I think this stock is going to go back up, and I think they're going to be looking good. So forward PE of 23, that's phenomenal. So right now the stock is super cheap. 23 forward PE when normally it's between a 26 and a 32. So I might even buy more of this. This one I didn't make into a huge position. So I might actually buy more of that. Look at this. Yeah. So this stock is super cheap right now. The other thing I would like to look at is their return on invested capital. I believe this company has phenomenal return on invested capital. And that's one of the biggest things I look for when I'm buying a stock. Yeah, I might have to buy more of this. This PE ratio is so cheap. The main thing I look for is consistency in their numbers. Yeah, look at that. 40% ROI. So you can't beat that. You can't beat that, especially the consistency there, but also for the net income. Yeah, look at the consistency and look at the growth. They're averaging 26% growth of net income in the last 5 years. And then let's go to, they're buying back shares. How's the valuation looking? Let's see. Let's go to the last 5 years. Yeah, I mean, the valuation is low right now. Here, let's buy. Wait, I bought a half a share this morning. I think I want to buy another half a share though. Let's buy another one. Yeah, because I like this valuation, and I love the ROI numbers that this company puts up. Okay, last one. There, lowered my cost basis a little bit. Last one is Ulta Beauty. Kind of similar to Lululemon, where it's the guidance is going to be down. The sales are going to be weaker for this year because of just consumer spending and the whole, economy situation we're in right now. But again, I don't know if you guys watch my videos from like last year, a year ago or so. Let's go back. I made money on this stock too when I bought it at, let's see. I did, because Ulta Beauty is one of the most dominant retailers in the United States. Yeah, okay, as you can see. So last summer, I was buying this up at what, 450, 460, 415, 420, 420, 375 I even got it at. And then I sold it at 513. I sold it at 513, 520, 520. And honestly, I think the stock went to 550. I'm pretty sure I missed out on a little bit of gains there, but I was happy. I was still happy with the gains. Let's see. Yeah, this stock went all the way up to $570 a share. So I could have made more. Now, will it come back down to this 370 price? I don't know. That'd be very interesting. I would, if it did go back down to, let's say, under 400 bucks, I would be very happy to buy a bunch of shares of this. And I do own this stock. It's just it's in my other portfolio. But this is another one where let's check the forward PE on this, because this one has a cheap PE on it as well. So no, we don't want to look at Cracker Barrel. Cracker Barrel is not a good stock. That one you're destined to lose money. All right, let's look at Ulta Beauty here. But yeah, when I'm buying into these retail stocks, I understand that, we're in an economy where its sales could be weak for the next couple of months, but I'm looking ahead to the market will always catch up and it'll always look ahead. So as soon as some good news comes out in 3 months or 6 months from now, and they say, okay, sales are going back up, then, by 2025, this stock could shoot up 30 or 40%. That's kind of what I'm betting on. Let's see here. We're looking at, so it's trading at 16 times trailing earnings. And we're looking at a 4P of 16. Yeah, 16. Normally it hit a 14 last. That was when it was under 400 bucks. If it goes down to a 14 forward earnings, that would be phenomenal. But even at a 16, I'm happy because look at this. It's normally at an 18 to 22. So I'm happy with that. Yeah, these are great prices. Anywhere around, even if we got like a 410 or 420, yeah, a $420 share price, those are great numbers for this stock. So those are my stocks that I'm currently interested in. Thank you for watching, and let me know what you think down below.